Good afternoon, everybody. Welcome to beautiful Miami. Welcome to the first ever Future Proof Citywide, and welcome to our panel. It's on the human side of M&A. My name's Sean, as you just heard. I'm executive editor of Daily Upside. We're a finance and markets newsletter with about 1 million subscribers, and we're super thrilled to be up here today talking about the human side of M&A. Because last year, M&A didn't just have a great year, it had the best year ever in terms of valuations, activity, just all of that. So it's literally had record level deal making last year, 272 transactions according to DeVoe. The fourth quarter alone broke records for activity, and that speed isn't expected to slow down as we settle into 2025. So it's an exciting time to be in the market for sure. But it's not always only about the money. And I said only about the money. There's a few other things, some real human components to these deals, right? I mean, succession planning was one of the top driving forces in the M&A. As we know, the industry is facing an aging workforce. Advisors are retiring. They're making these life-altering decisions that are difficult. They've had decades of their lives spent building these companies and these practices, and it's certainly not just an economic decision. We're here to iron that all out for you, to figure out how to prepare your practice, how to set it up to have the most enterprise value in the sale, but also how to prepare yourself mentally around some of the more human elements to this. So we have an awesome tag team panel, and I think we're making future-proof history. We have the first time we have a husband and wife duo up here. So we have Liz Fritz, CMO co-founder of F2 Strategy, as well as Doug Fritz, executive chairman at F2. I'm assuming we don't have to explain to anyone why it's the F is squared in F2 Strategy, so we'll dive right in. And maybe we'll start with you, Doug. Just maybe from a 30,000-foot level, what have you seen with explosive M&A that we've seen, and what does that mean for the industry?
Yeah, it's a great question. M&A money coming into this market, from advisor growth, brands getting grown, technology for sure, like that's our world, technology and marketing. The influx of capital means that the core of this industry, which are the independent wealth firms, suddenly get attention. And by attention, they get to grow to national brands. They get the kind of funding to build operations and technology that is world class and what investors in this country really care and need. And it's really a maturing of our market that is, I've been 27 years in wealth management technology. I never thought I would live to see the day where the core of this industry is well funded and prepared to be propelled into the future. So it's phenomenal for growth and for just professionalism. I think we're going to talk about it a little bit. There's some downsides to that as well, like too much money flowing in could also pose problems, but generally it's good.
Sure. And we've seen a lot of PE money too coming in, which has been, amazing to see the interest from some of these huge companies in our space. Again, maybe there's some concerns about having that much PE money, but where do you see the opportunities there? Why do you see the PE money coming in? Do you think it'll continue as we move forward in 2025? Yeah,
I think 25, barring any kind of significant catastrophic market meltdown, and even if that, I think PE money is still going to be flowing in. There's just such a great opportunity for investment in a highly sticky, human-centered, sort of demographic, accelerated investment in this country. Continuing to see money flowing in, continuing to see firms using that money to build national brands and accelerate their own growth. I think that's I was looking at it the other day, the number of firms 5 years ago that had in wealth management, that had greater than 100 billion in assets that weren't a wirehouse. You could count them on a couple of hands. 5 years in the future, 2025, the number of firms that are truly systematically mature, $100 billion plus firms is in the dozens now. And I think in another 5 years, we're going to continue to see that growth and brands that are going to be coming out of the woodwork. And all of that is about the industry recognizing how valuable this part of the financial services industry is, how valuable the companies are, how sticky those relationships are, and how much a little bit of money and aggregation and some technology and some marketing and operational support can fuel growth.
Yeah, for sure. So maybe we can dive into a little bit go a little bit more granular on how you think about your business as you prepare for a sale, right? So maybe like 2 to 3 years before, or whatever the timeline may be. I know F2 had some recent funding. I know you work with a lot of RAs, tech vendors, all sorts of kind of industry folks that are thinking about these deals either to get scale, for an exit. What should owners be thinking about if they're thinking, okay, 2 to 3 years, I want to retire, I want to exit? How do you build enterprise value as you're heading into a sale?
Yeah, it's a great question. So for those that don't know F2, which is probably most of you, we're the largest pure play wealth tech and marketing strategy consulting firm in the country. About 140, 145 full-time employees at F2. And so what we do, and this is kind of getting to why my answer is, this is not a plug, is we work with both the smaller RIAs that are looking to get capital, so they're prepping to go for capital. We also work with the aggregators that are acquiring firms that are looking to transact, and we also work with the private equity firms that are doing diligence on either platforms to create aggregators or working with their RIA aggregator to acquire other businesses. So and then also we sold our company, controlling interest in our company a year and a half ago to private equity. So we have a really unique view of all the pieces here in the market. Right. And I think what we see firms do well and prepare for a transaction and do a great job, but sort of 2 to 4 years in, a couple of kind of key things we see. So one of them is truly think about what is capital going to do for the business you've got. If you've got a capital provider that can plow $100, $300, $400 million into your business, what would that do to you? Do you have the infrastructure? Do you have the operations to support that? Do you have a brand? We're going to talk about the brand in a second, but are you prepared to be scalable? And most firms that are going for a first investment and going to become a platform firm, they're going to acquire other businesses, haven't yet thought about scale. They think about their business, and they've been in business for 25 years. They've got a brand, they've got clients, they've got advisors. They themselves haven't thought seriously about what would a 10x of the assets you currently have look like and operationalize and feel like. The vast majority have not thought that through. The clients that we work with, we can get them to think about that pre-money, or when we're helping PE firms look at firms that can become platforms, that's when we're really looking at do you have your data right? Have you thought about your data? Have you thought about workflow? Have you thought about client journey so that you're creating great referable experiences all along the client journey? Those are the firms that have done it really well. And the other thing I would say is pre-sale, 2 to 4 years before sale, get to know the players, right? Get to know the bankers, get to know meet with the people that are looking to acquire businesses, talk to people who sold their business, and what was that experience like? What did you learn? What would you have done differently, et cetera? All that you should be doing well more than 2 years leading up to any kind of a transaction. And then sort of 2 years on, it's sort of the numbers, the math, the EBITDA, showing that you can actually pour gasoline in this fire and it's going to really take off from a growth standpoint.
Yeah. Maybe what are some of those things we can do to help scale? I know in our pre-call you mentioned about just trying to find those levers that you can pull or some replicable processes. Are there certain things that are kind of universal to advisors that you can say, okay, put these in place? I mean, you touched a little bit about on data. I'm sure that's very lucrative for some of these acquirers, but what are some of the, are there certain steps that you can kind of take to?
Yeah, I think what we like to see most when we're working with private equity to invest are, do you have a unified client experience that is repeatable, highly repeatable? And oftentimes that is, but not always, but baked into a CRM or a marketing and lead gen process that you can continue to invest in and it's going to scale and grow. If we're looking at a firm on behalf of our clients to invest in and they haven't really gone through a proper client journey map, they haven't thought about the use of their data and pulling analytics from their data, let the data from my company help me build and grow a better company, or they haven't really thought about organic growth in their marketing message, et cetera, it's a red flag that my client, my private equity client at that point is going to have to build that after the sale, and our valuation sort of has to bake that in. If it's a $5-10 million reno, we bake that into we help them bake it into the sale price.
Interesting. I want to remind everyone to please Q&A at the end of our talk. So if you want to put them in, you can put your questions in the app. We'll get them up here, and we'll have Doug and Liz take them. I want to say I'm so happy I did my hair this morning because I don't know what's happening. how about we talk about branding a little bit? I think we mentioned that. I know, Liz, you've done a lot with F2 and others and the companies that you guys consult. As you're thinking about this, obviously having a strong brand is at the core probably of a lot of these deals. What is it that you think about or that you tell some of your clients about their branding, how to strengthen it, how to prepare it for a sale?
Yeah, that's a great question. And so a lot of folks ask kind of like, actually, I get this question probably once a week of like, how do you work with your husband? I could never work with my husband. For a little bit of context, we very early on realized and understood lanes. And so my lane and my kind of historical involvement with F2 is brand. And so I was the legacy CMO of F2 strategy. So everything from digital marketing to thought leadership to PR, all of that was me. And Doug we were able to run in parallel, building the company together. So that's kind of a little bit of backstory of how we complement each other, the marriage of talents. So brand is really, really important, and that's been my focus. And we've really, to kind of supplement what Doug just said too, is making sure when you're in that process to surround yourself with coaches or mentors or folks that have been through this before, because they ask really great questions around scale. Everything, we've had great coaches that have said every idea that you have, make sure that it's replicable multiple times, right? So when you're gonna build something, build it so it can go on rails. And that goes on for brand as well. And so literally from day one, my focus was a little tiny 1X marketing team building a 10X brand. And how do you create brand for scale and how do you build brand for value? And so really early on, 2 to 3 years, I mean, we started day one because that's my area of focus of building a brand where you're adding value, you're positioning yourself in the market as a thought leader, as somebody that has a personality, so you're known. So when you go out there and have conversations, you already have that surround sound of credibility, of thought leadership, of personality when you're out there meeting with those potential partners. And the other thing that pairs that too is your internal brand or culture is something that is also really important. So it's kind of like know thyself before you go out and date. We did a lot of work internally to understand what our core values are as a firm. How do we operate? What's really important to our mission that makes us different, not only to our clients, but to our potential partners? So I really encourage folks to also take that time to work through the who am I before you go out to see who you might be compatible with.
And then just to kind of follow on to that, so if you're, from an investor standpoint, when you're looking at that firm and the firm has no social media presence, they've got no real sort of in-brand market, they're a federation of folks that just know folks, right? Like, I got 10 different accounting firms in my great geographic region and they're all referring me tons of business. Your brand is just with 10 accounting firms. So that's really hard to pour gasoline on and invest and grow. And so there's big national firms like Carson and Fisher and a few others have built phenomenal national brands super intentionally over time, and you can invest in that. You can put more gas in that fire and that brand will continue to grow. Building it from day one is really hard unless you do it intentionally, which I think what Liz has been doing for F2 for 9 years.
Yeah, are there ways to think about intentionality? I mean, I think you touched a little bit on authenticity in your branding, obviously on social media is such a huge part of it. Are there ways you can think about trying to, like, getting down to that core, understanding who you are, but then how do you project it out to others? How do you kind of get ready to pour some gas on it?
Authenticity, I always lead with authenticity. I always joke I'm a chief marketing officer, but I am nervous when it comes to social media. It's sometimes hard to put yourself out there. And so working with a team to really articulate just a simple messaging grid around who you are and just kind of get that drumbeat, and some of the folks surrounding you is just having that same drumbeat so that you're reinforcing that in-person relationship that you have with folks digitally. It's kind of table stakes now. We don't have the option not to have a digital footprint. A lot of our next gen clients and kind of that modern investor is going to do a lot of that due diligence on their own. And so you want to make sure you have some footprint. No footprint really is a red flag. Again, I think in a lot of ways you can be taken too far. You want to make sure that you have time with your clients, but coming up with systems that you can rinse and repeat monthly. Again, it's that like 1X effort for 10X return. What kind of systems can you put in place around your thought leadership, around posting content that's authentic to that voice? Go back to that messaging grid. So it's really a process, and I'm sure a lot of you have done this with any sort of decision, is you have a bit of your values. how you decide on technology, what type of client do you serve. Those types of questions also help fuel that cultural authenticity. Who are your clients? What do they expect from you? Ask your clients. A lot of our clients will do surveys and weave that into the question of who are we to you, and start to kind of build that core to yourself, and then come up with a couple simple things with social media so that you can, or your website or video if that's your thing, but starting just kind of make an echo chamber so that when you're sitting down with potential partners, you walk in with this aura of they kind of have a sense of who you are, and you kind of have a sense of where they are, and you can start the conversation a little bit ahead of the line versus maybe getting a little too far down the line and being like, oh wait, this may not be a great fit.
And then, like on the tech side of the marketing and tech, the experiences you build for those prospects and clients, if it can meet the expectation that that individual had walking into your office, because it had a sense of who you were from social, your website, your referral network, if those early experiences can cement what they were expecting to see, which is really freaking hard, like it's so helpful for growth and getting people on board to trust you and to go. When they see a brand and then they meet with the advisor, and there's just a disconnect there, especially through firms that have acquired many firms. So they have one brand, but like, yeah, I know that I'm part of this firm, but like I really came from this firm, and we kind of do things differently. Like your credibility is in the toilet, right, at that point. And then from a tech standpoint, like Liz says, this is one of our first questions for a new client of F2's. How do you win? Why do people work with you? A really simple question. You would think this is like tattooed on everybody's eyeballs. Like, yeah, how do I win? Like, how do we win clients? I'd say 9 times out of 10, we get crap answers from the presidents and the CEOs of the wealth firms. It's like, well, we're kind of fiduciaries, and like we're like some vague answer. So from a marketing and tech standpoint, if you don't know why you're winning, you don't know what specifically types of clients you're going after, it makes both marketing to those people and then building the tech to deliver on the needs really freaking hard.
Yeah, true. So you want to lean in on your strengths and get to know what you're doing right, so then you can 10x that. Thinking about a little bit more, and guys, if you do have questions, feel free, shoot them our way. We have about a little over 10 minutes left, so we'd love to hear from you guys. But yeah, so maybe thinking a little bit about some of the more human kind of struggles maybe that people go through with this. One that comes to mind that I don't ask a lot of RIAs that I talk to. I'm just curious about is like, what about the relationships between employees, between maybe you have co-founders, maybe you have people that have been there for 15 years. How do those conversations work? How are advisors thinking about that? Like, I'm ready to retire, but how can I make sure that the people that have helped me get to where I am are supported and make sure they're taken care of for their futures as well?
Shit. All right. So that's tricky, and I know that because we've been through that process as well. So the people that helped F2 get to a state where private equity was really interested in investing in us and sort of building this aggregator of services firms. I know what we did with our really critical early stage employees is made sure that both going up to that transaction, they were part of the monetization of the value, which is incredibly difficult. There's mechanisms like phantom equity, partner shares, et cetera, that you can pursue. Different tax consequences. Talk to your financial advisor, and talk to your lawyer about what those are. But then through the transaction as well, making sure that the success of the new entity, like they are elevated in that value chain, not just another, we were kind of with F2 when they first started, but we're not as critical to the success because now you got private equity, a bunch of other founders that are coming into the business as part of the acquisitions. So making sure that those really critical people are part of that value, and that we've been able to do a good job of that. I think a lot of our clients that are going through this process are really trying to think about how to transition not just equity and value, but a sense of true ownership around the business, which is also incredibly difficult, it's a whole separate conversation, I think, but it's making sure they're part of that value chain.
Sure. No, that makes sense. So some of the other challenges maybe, I think we talked about a little bit, just mental challenges, right, of kind of handing over the reins. I think you said, Doug, that it was hard to kind of be that, to take that step back and from a day-to-day operational standpoint to someone that's maybe more, looking at the sidelines, or for a lot of these advisors and for these tech firms, that might be the case. What should you think about with that? I mean, how hard is it for advisors that are thinking about it, and what can you do to kind of help yourself kind of really hand over the reins?
I'm going to make Liz answer this one.
We call it the founder's journey. I think it's over the last year and a half, and I have we have conversations with business founders all the time. There's an emotional journey, an emotional arc that you go through, and there comes a point where you need to make a decision on what path you take. So do you stay smaller, maybe a lifestyle company, or have you been building to scale and you're looking to a partner? So there's like really fundamental decision that needs to be made. When you come to that decision, and if it is to take on a partner or accept capital to come in to scale, understanding that, again, kind of reiterating what we said, of putting the work in, of making sure that you've put in really great foundational mission and values into your firm. You feel true of who your firm is. You feel really confident in the partnership that you're taking your firm into. Bring your core employees along in that journey, both monetarily, but also within building and expanding the culture. Make them feel part of the journey, create opportunity there. And then we kind of call it our third kid. We have two boys, they're 9 and 11. F2 is kind of our third child. And I like to use the analogy of you put in the foundational values into your kids, but you kind of need to let them grow into what they're going to be. And so when Doug and I personally made the decision to take on a capital partner and to grow F2, we realized that while the core of F2 will always be there and we are champions of that mission and all employees can live and breathe the mission of F2, it is time for it to grow and expand beyond us, beyond our skills. When you get capital, we've been able to surround ourselves with some of the most amazing experts that are way better at what they do than we could have been, and letting them grow the firm. So it's almost like this emotional letting go, but also making sure that you are reiterating and championing that mission that really your business became successful with, but letting it go at the same time and building a trusted circle of folks that will take it there with your almost oversight, and kind of off to college it goes.
Yeah, I just going to continue that one. It is super hard, right? Like, our kids are young, so they haven't been married, they haven't had a college yet, whatever. But if you have kids that get married or go to college, like, there's some part of you like, that's not the college I would go to. That's not and you got to be okay with it. And trust the fact that you put the right people in the firm, you brought the right partners in, and then just step back and you're operating as a founder, but in a very different way than like 7 days a week, 12 hours a day, hammering on owning everything and controlling every little piece. And we see this with our wealth management founders and CEOs as well, that the really good ones can take a step back, realize that their role in that firm now is different. They're a figurehead, or they are the branding and the messaging voice of the firm. But the day-to-day operations, they're going to bring in someone far more capable of operations, technology, marketing, middle and back office servicing, like hiring people, HR, finance, the CFOs. Like, they're going to bring in phenomenally qualified people. And ultimately, as awkward as that feels for a while, the long-term value, the long-term brand that they help create is going to be fantastic. They're just not going to own that success themselves. And that is a human, right? There's a human side of M&A here. That's what we're talking about. That's freaking hard. And everybody's seen brands where the founder has sort of sold and either just like full-on pieced out and left everybody else in the firm to go deal with the detritus. And we've seen situations where people have hung around way the hell too long and tried to put their thumb on every little piece and caused problems. And so that's a very narrow path to walk perfectly. I can't think of anybody that's walked it perfectly, but we're seeing it happen so many times in the industry by folks that are being acquired and kind of getting capital. And there's a behind-the-scenes human story that I think we have a unique perspective on. It's cool.
Yeah, no, it seems like such a tight rope to walk, obviously, and you probably don't know how you're going to feel emotion until you go through it, just like sending kids off to college and some other examples. We have about 5 minutes left, and we do have a question come in, so I'll give it to you guys.
I just want to quote that we were the first ones at Future Proof to get a Slido question.
Yep, that
I'm
is
assuming
true.
it's not from our employees, but keep on.
We can't guarantee that, but we will ask it from Anonymous. Do you view agentic AI as service as a software or software as a service? And will there ultimately be one large LLM similar to search engines 20 years ago? What?
Oh yeah, so everybody's seen Terminator and Skynet, right? Like we're all just plowing towards that. No, one LLM model, hell no, right? Like, because the PII, the private information nature, what we're going to want to do with our data is so still critical. I don't care what technology you put on top of that. Like, we're going to need to own that stuff ourselves. But there are technologies coming right now that are able to take multiple LLM models and make them really, really valuable, whether you have it inside or outside, and then sort of break through the internal, external walls of AI. So F2 as a company, because we're 130, 145 full-time people, all of us came from wealth management industry. None of us were, I would say, technically consultants that started as a consultant. We were all CTOs and CMOs that came to the market. We are very risk sensitive. Like, we are highly risk sensitive, and because our relationships with our clients tend to be over, 5-10 years in length, we're very leery of bringing new technology to our clients. Everything that comes into this market, robo-advice, crypto, even direct indexing kind of had a really hot couple years ago. We were always sort of, we're going to work with our clients on what works and what we know and is proven has worked well. This is the first time, early 2025, where our clients using AI, LLM, internally predictive engines and next best action have proven so valuable that now we're saying, like, yeah, this stuff is real, and it's going to be great. So the future of unified LLM, I think there'll be great technologies that can bring it together, but I don't think everybody's data is going to be available to everybody.
We could probably stay on technology for a second, because especially in the tech, just the wealth tech world in M&A, we've seen a ton of consolidation recently. But even when I was in September on stage, we were talking about just the Kitsis map and how you just need like a magnifying glass at this point to find certain companies. What do you see the future in there? I'd be so surprised if there wasn't a ton of consolidation coming down the road, but would love to get your opinion on it.
Yeah, it needs to come with like a microscope, I think, at this point. I don't know. So there's two sides of this. This is a crappy answer. Just get ready for a crappy answer from Doug. But we're going to see more firms on that map because there'll be startups that'll join. But we'll also see firms that can't make it as a business. And at some point, the best intended venture capitalists or best intended family offices that have funded some of these tools can't continue to support it if it doesn't have its own feet to stand on. And we're going to have to see some come off. And then somewhere in between, we're going to see an aggregation of technologies into larger and larger players. And so I think the list will grow, but it'll change dramatically over time. I would love to say that some of the smaller firms are all going to get hoovered up into larger firms, but I know that acquiring smaller technology into a large, it's a pain in the ass versus just build it yourself, honestly. So I don't think there's going to be a lot of that. And the one thing that, the Kitsis map is phenomenal because it'll tell you all of what's available. It's like the yellow pages, right? It'll tell you everything that's available. You need to talk to your peers. You need to kind of work with people that are like you. If you don't have like 10 friends that have your same job at firms that look like you can ask questions of, you need to ask other people which one of these things is working for you. Because then the Kitsis map tells you what's available. It doesn't tell you what works for firms like you as much. There's some really good stuff done by Craig Iskowitz working with Michael Kitsis on like integration mapping. I'd highly recommend people look at that. That's very valuable. Yeah,
analysis, paralysis, and all that stuff. Just really quickly, flash round really quickly. What do we see coming down the pipe for M&A? You're just seeing it explode, keep exploding, no end in sight. What do you see for 2025?
I don't think it's going to slow down. I think that the piece that I'm waiting to see, and you guys this will be like they call it the F2 moment when it happens, is when an aggregator firm at 30 to 70 billion gets acquired by another aggregator firm, right? And we'll start seeing. I mean, you can imagine the size of that deal and the valuations that have to go into it. I just don't see how that doesn't happen, to be honest. Where a $150 billion firm acquires another $150 billion wealth firm, and suddenly you got like a monster $300 billion wealth shop. The cautionary tale on that is that most of the $150 billion wealth firms we have today in the country aren't actually operated like $150 billion wealth management firms, coming from big Wells Fargos and Wachovias in my background. The controls, the infrastructure that some of these firms need to get to doesn't always exist. And so there's a little cautionary tale that as these firms get bigger, as they acquire each other, it could be systematically risky to our economy to have $300, $400 billion wealth shops that maybe don't have all the bells and whistles and controls in place.
Yeah, well, I can't wait to write that story, but I think that's all the time we have for today. You guys have been fantastic. I know I
Thank
learned
you.
a lot.
Thanks so
I
much,
hope you
Sean.
all did too.
And we're gonna
Thanks,
go. We're gonna go over to the recharge zone. If you have questions you didn't get a chance to put in, we're gonna go over there and
For
answer
sure.
questions.
Enjoy the show, everyone.